Diversification helps investors minimize idiosyncratic or individual risk in a portfolio by combining many different types of assets into a portfolio and therefore reduce the portfolio exposure to any particular asset or risk. Portfolio diversification is affected by the correlations between assets and number of assets included in the portfolio. Lower correlations between assets and higher number of assets means greater diversification. Nowadays, it's common sense that a prudent portfolio diversification should encompass various asset classes: stocks, bonds, derivatives, commodities, real estate, private equity, etc., and a diverse set of sectors and regions, domestic or foreign markets, and developed or emerging markets. Besides diversification across market capitalization, small and large cap, for stocks, things such as maturity, credit rating, and sensitivity to interest rate for bonds should be taken into account. The historical returns of selected investments in your portfolio should not have moved in the same direction at the same time, and ideally they would have moved in opposite directions. For example, you have 55% stocks, 40% bonds, and 5% real estate in your portfolio. Suppose bonds and real estate perform well during an equity bear market. When the stock portion of your portfolio is shrinking, the rest of your portfolio is growing. In this way, you may offset the negative performance of stocks with positive performance of bond and real estate in your portfolio during an equity bear market. It is costly to build a well-diversified portfolio, especially when you want to include a large number of securities or some foreign securities that can be hard to get access to. Mutual funds or ETFs are good alternatives that allow you to buy a share of their diversified portfolio at lower cost.